Dr. Babasaheb Ambedkar Open University.
Hello my dear friends and my dear student, I am welcoming to you to Dr. Babasaheb Ambedkar Open University in Chaitanya Studio for the video series of the BBA regular in the paper number 202 of the Fundamental of Financial Management with respect to block 4 and unit number 3 in the continuation of the unit number 3 of the financial planning 2. Now let's begin our discussion with the difference between the forward contract and future contract. Now my dear friends, as we learned in the last session, what is the meaning of derivatives, then the structure of derivative products, then the different types of derivative. In that we discussed the 4 major types of the derivatives, that is a future contract, forward contract, options and the swaps are there. Now let's begin our session with the difference between the forward contract and future contract. The basic difference, or we can say the first point for the difference between these two contracts are that the forward contract can be for any amount as per the requirement of individual parties, while in a future contract it is not available for a particular amount because it is required to be prescribed the amount only. The availability of the funds is very easiest in a forward but not in a future. The forward contract can be non-standardized from it, where the future contract is standardized because the standard rate and standard specified, they define the future date also. Then in a forward contract, it is not regulated through the any statutory, while the future contract regulated by the exchange, legally empowered by the enforcement of that particular contract. A forward contract is not transferable to the other parties. It can be cancelled or extended by the mutual consent of the parties. Therefore, it is not very liquid or a flexible in respect of the amount for it, while the future contract can be traded officially on the exchange on which it is enforceable in nature. Therefore, the future contract can be considered more liquid even though there is no flexibility in its amount. The next difference, that is a forward contracts were originally designed without involving any marginal payment. But in these days, the banks insist on some marginal deposits are there, and these are not a periodical variation payment, and therefore they are the greater risk of a default in a nature. While in a future contract, there is always a margin payment at the time of the entry, and there are the periodical variation payment which are payable by the one party and receivable by the another party. And this variation payments proved that an umbrella of the protected to the both the parties. So here protection is granted. In a forward contract, there is no protection at all. So this is, my dear friends, the difference between the forward contract and future contract. Now let's begin our different topic, that is the financial planning and preparation of the financial plan after the requirement of external fund policy is determined, that is EFR. The financial statement are used in understanding the past as well as to providing the starting point for the developing financial plan for a future. Ultimately, my dear friends, we can say that this is a nothing but to determine the future plan in an efficient way. The financial plans begins with the firm's product development and sales objective. A corporate entity can possibly aim at either a normal growth plan which aims at a percentage growth in a sales, and this probably does not aim at making the inroad into the competitor's sale. If it is an aggressive growth plan which calls for an increased market share or entry into the new area, or we can say the new product will call for the heavy investment burden on the machinery also, in equipments also, land, building, etc. That means your financial plan can be analyzed with your vision and mission of your particular project. And ultimately it's defined that is a aggressive growth plan or in a different way. In this particular way you have to analyze it and you discuss the different types of economy as well as the different requirements of financial management, etc., like working capital, capital budgeting, etc., capital structure over that. So you have to determine it. On a sale forecast, in any case, it needs to be translated in a future cash flow. If future operating cash flows are insufficient to cover the planned investment in a fixed asset and working capital and to meet the planned dividend payments, then the balance has to be made good by the borrowings or by the issue of the new share. So ultimately, my dear friend, it is justification or justified it how it will be determined or measurable in nature. In the chapter 1 of the financial management, we determine the different requirements of fund, that is internal as well as the external fund requirement. So we had discussed the EFR, that is external fund requirement, in a previous session, or we can say in a previous chapters. But this was introduction to what is now understood, that is a financial plan. In that chapter we just analyze and just evaluate the concept of EFR. Now you have to justify with the financial plan. So we will sum up it with the 4 steps. The step number 1 is the project for the next year's operating cash flow, assuming that the agreed percentage of increase in a sales. That means you just assuming the percentage of sales may be in the future. Step number 2, project the additional investment in working capital and fixed assets that will be necessary to support the higher level of activity. And my dear friend, at this stage you also take into the consideration of the dividend payout also, that is dividend payout ratio. In step number 3, it observe the difference between the projected operating cash flows as per the step number 1 and projected uses of the funds as per step number 2. And the difference represent, that is the difference between step 1 and step 2, that is the cash to be raised either by the borrowing or by the issuing share. So here, my dear friends, you justified that the step 3 is nothing but it will be always depend on your step 1 and step 2. That is your projected operating cash flows and projected use of funds. Step number 4. Once it is decided about the mix of the debt and equity, it is necessary to prepare a projected balance sheet that will incorporate the new level of asset and raise the retained earnings and the new debt as well as the equity. So these are the 4 steps of financial plan for, we can say, the EFR, that is external fund requirement. So let us briefly discuss and recap that 4 steps. The first step is that nothing to you, just a projected operating cash flow with the percentage of sales. Step number 2, that is nothing to projected use of funds in step number 2. And step number 3, there is a difference between step number 1 and 2, which will be defined that whether you raise that money by the borrowings or issuing the new share. And step number 4, my dear friends, it is justified to the mix of the debt and equity necessary at that point of time, and you projected the new balance sheet and you analyze it whether your retained earnings are there, fixed assets are there, and the new debt and equities are there. So these are the 4 steps for determining the EFR, that is the external fund requirements. In that, my dear friends, in actual practice, it is possible to set up the spreadsheet which can be projected for next 5 to 7 years in the terms of projected income statements and projected balance sheet. The financial plan established will become the financial goal and should be taken as a benchmark for evaluating the performance in a subsequent year. That means on the basis of today's analysis or with the taken up that particular 4 steps, you may analyze the income statement and balance sheet, the projected income statement and balance sheet for the future 5 to 7 years also. For external fund requirement is leading to the financial planning. The external fund requirement model assume that if the sales have to go up, then the investment in the all assets should be proportionately go up. So we can say that the one particular aspect is a good in nature, then ultimately it analyze and it projection your whole balance sheet in a good way. So this is the generally true for the current assets, but not true for the fixed assets, and therefore the model is defective to some extent. Yes or no, my dear friends? Because if the sale will be go up, at that point of time, investment in all assets are proportionately will be the increase or go up, but not a fixed asset. Why? Because your depreciable provisions are there. So you cannot take it into that if your current assets are grown up, at that point of time, the fixed asset will also go up. And this model is also assumed that if the sale go up, and spontaneously the liability will also go up proportionately. And this is also a logical reason behind it. A formula is available to calculate the external fund requirement, but it is advisable to understand the fundamentals behind it. Why we are calculating that EFR, or why we are going for the projected balance sheets. So we can calculate EFR, that is external fund requirement, by preparing the projected balance sheet for the sales from the past turnover. So ultimately it's justification of your projection of your particular financial plan with respect to the balance sheet item, income statement items, etc. Now these are the 4 steps for calculating EFR, that is your external fund requirements. The first step is calculate the conversion factor and determine increase in EFR. This is the first step, and these are the most efficient 5 steps, my dear friends, where you can actually project it, the balance sheet as well as income statement, and you determine the financial forecasting planning. So step number 1, my dear friends, you have to remember for the solving a problem or calculate it, that is calculate the conversion factor and determine the increase in a EFR, that is external fund requirements. Step number 2, my dear friends, calculate retained earnings and add it to the previous year's balance. Step number 3, calculate all assets and liabilities as per the conversion rate, that is your factor, conversion factor in step number 1. Then step number 4, that is remaining funds to be arranged from the equity share capital. And step number 5, do not apply the conversion factor to the equity share capital and retain earnings, because ultimately it defined and is justified on that the remaining of that particular projected balance sheet. That's why you have to nothing to define it. So these are the major 5 steps for the forecasting of financial planning. Now let's take one problem or one example over it. The example is like that, or problem is like that. That is the balance sheet of the Pradhan company at the end of the year 2020, which is just over is the big and the below, that is a rupees in 1,000. The share capital will be 50,000, retained earnings is 60,000, long-term loans that is 80,000, short-term borrowings like 60,000, trade creditors 50,000, then provisions are 20,000. Ultimately you calculate that is a 320,000. That is 3,20,000. Then on the asset side, that is a fixed assets, that is a 130,000. Then inventory, that is 90,000, receivables 80,000, and cash is 20,000. So total will be the match up over it. In that, they define that the sales for the year just ended with the rupees of 4 lakh, and the expected sales for the year 2021 is rupees 5 lakh. This is ultimately increase on of rupees 1 lakh. So net profit margin is 5% and the dividend payout ratio is 50%. Now determine the external fund requirement of Pradhan company or Pradhan Limited for the year of 2021. Now let's example and start the answer with the first step, that is a conversion factor. Conversion factor is determined by the new sales divided by old sale. Our new sale is a 5 lakh and old sale is rupees 4 lakh. So your conversion factor will be 1.25. Now step number 2 in determine that is calculate the retained earnings and add to the provision of the year of balance. So we justified it with the futures of the EFR, that is old total assets, that is 320,000, multiply with the cash flow minus old assets, that is ultimately the 320,000. So 320 into 1.25 minus 320, that is your difference is rupees 80, that is 80,000 in nature. That is all amount are in 1,000. So not to worry, I am justified it with respect to the only and only that particular balance amount, whatever the sum are explained. So these all are the amount in 1,000. Now the third step, that is estimated retained savings, that is sales, that is your 5 lakh, multiply with the net profit margin ratio, that is a 5%. Then you have to minus that dividend payout ratio of 50%. So 5 lakh multiply with the 5%, that is your 25,000, and dividend payout ratio will be on that is 25,000 divided by 50%, that is ultimately the 50%, that is 12,500. So your estimated retained saving is 12,500. Now let's the main and the heart of the EFR, that is external fund requirement, that is you justified it with the old and justified with the new one. The first is particulars, then old amounts are there, the balance of the amounts, or we can say the balance sheet items are there, Next, you have to multiply with the conversion factor. Then you determine the new rate, and whatever the increase and decreases are, then you justified in a last column. So let's begin that with the first assets. So in our sum there are total 4 assets are there, that is fixed assets, inventory, receivables and cash. Inventory is 130,000, then fixed asset is 130,000, inventories is 90,000, receivable 80,000 and cash 20,000. So here we just put it into as it is, that is 130, 90, 80 and 20. So total will be your 320. On that you just convert it with the conversion factor, that is 1.25. So 130 multiply with the 1.25, then you will be get 162.50, and whatever the difference between new and old, that is 130 and 162.50, will be determined as a increase level, that is 32.50. Next is inventories are there, that is inventory of 90 multiply with the 1.25 conversion factor, so you will be get 112.50. The difference between 112.50 and 90 will be appear as an increase level, that is 22.50. Next is receivables. Receivables at rupees 80, that is 80 multiply with 1.25, so you will be get 100. The difference between 100 and 20 will be determined as a increase level, that is 20.20. Then next is cash, that is 20 multiply with 1.25, that is 25. So difference between them, that is a 2. So while we are calculating it, your total will be 320 and 400, so your answer will be 80. In my answer, that is increase level of third, that is receivable, is increase level is 20.20, but ultimately it's at 20 only. So now let's take a example of it, and again the rewrite the liability. So now here the liabilities are share capital, retained earnings, which we don't want to write it. So share capital and retained earnings we don't want to write, so directly comes for the long term loans, short term borrowings, trade creditors, then provisions. So long term loans 80,000, then short term borrowing 60,000, trade creditor 50,000 and provisions are 20,000. So here just we write that the long term loan, short term borrowings, then trade creditors and the provisions are there. So here also we write that the 80, 50, 50 and 20, we have to convert it with the conversion price or conversion factor, that is 1.25. So 80,000 multiplied with 1.25 conversion factor, then it will be the 100. So your increase level is 20. In that short term borrowing is 50. So 50 multiplied with 1.25, that is 62.50. So ultimately it determined 12.50 increase level, in same as a trade creditors. Last is your provision. Provision is 20 and 1.25. So 20 multiply with 1.25 will be determined 25. So difference between 25 and 20 will be defined as an increase level of 5,000. So total will be 320 in an old segment of asset, and in the new segment, that is 210. In a new segment of the asset is a 400, and in a new segment of liability will be 262.50. Same as increase level is 80 and 52.50. So let's the deduct from asset to liability, that is 320 minus 210, which will be define the difference between your asset and liability is 110, where it will be granted this to be spread from the retained earnings and share capital. So now let's take an example of it. Here just I missed out, that is your earnings over it, her earnings and the equity share capitals. So my dear friends, here your share capital is 50 and earnings are 60. So we just put it down, that is a retained earning in 60 in old, and we just messed out with the 50 rupees. So equity share capital is a 50, not a 110. So 110 is a total requirement of earnings as well as the equity share. So here just I miss out the one point, that is a 50 of in old regime, that is a 50 is your equity share capital. Do you don't want to convert it? So ultimately the 60 with respect to the 72.50, that is your conversion rate will be over it, that is 60 multiply with 1.25, so 72.50, and again you 50 multiply with 1.25, so will be get 62.50. So here there is a difference between it, that is 12.5 and 12.5, so we'll be determine it that in a easiest manner. So this is what, my dear friend, the EFR, that is external fund requirement, as calculated, that the determine and the predetermine this 5 step to how to calculate, that is EFR. After doing it, let's sum up with the today's session. That is, in this unit we discuss the different types of the derivatives. There are majorly 4 types are there, that is a future contract, forward contract, option and swaps. Then we determine the difference between the future as well as the forward contract. After that we discuss the different and how to determine the EFR, that is external fund requirements, with respect to how to evaluate in the different eras and different calculations portion and different steps to be evaluated the EFR in your financial forecasting level. So in this way you justified and you determine that how the assets and liabilities are shown up with requirement, your external funds requirement as well as the internal fund requirement, and on that basis you justified it your the performance of the financial planning in a different way with respect to your the needed sources as well as your available resources, and how you evaluate and how you calculate and how you arrange your financial plan with respect to your projected balance sheet as well as the income statement. After study and after watch this video, you have to take an example, or we can say that you have to determine and write a question, that is a long question. There are majorly 2 questions are there. First is explain the concept of derivative with its different types. Then second is how the future market transaction is beneficial to investor as well as traders, and explain it with the examples. So you have to justify this 2 questions as a homework. Next is you have to determine or you solve this 3 multiple choice question. First is the dash are the most modern financial instrument in a hedging risk. Whenever we talked about the hedging risk, then it will be treated as a derivatives. Second is that which are the contracts can be for the any amount as per the requirement of individual party, that is nothing but your forward contract. Then which is the leading of the financial planning, that is EFR, that is external fund requirements. After watching this video and after solving this multiple choice question and you write the long question, if you want to study more with respect to this chapter or this subject, then you may refer these 3 most efficient and the effective reading books are there, that is Financial Management by the Ravi M. Kishore, then Financial Management by the I. M. Pandey, then the Financial Management by the P.C. Tulsian and Bharat Tulsian's books are there. So hope you study well in this session, hope you learn well in this session. Hope you determine that how you analyze your financial statement and how you prepare and forecasting the financial plan with respect to the external funds requirement as well as the concept of derivatives are in a modern era. So hope you learn well, hope you do well. Thank you very much. Have a great day. Have a great future.